Have you ever seen an investment with a name so long it just feels intimidating? Well, today we are cracking the code on one of those. We're going to demystify a fund that sounds super complex, but I promise, by the end of this, you'll know exactly what it does, how it works, and why it might be on someone's radar. So here it is. This is the fund we're digging into today from the Wealth Company. And you know that logo with what looks kind of like a chess piece? It's actually a pretty good clue. Because investing, especially with a fund like this, is all about strategy. And this fund makes some very specific moves we're about to break down.
Okay, let's just put the whole name up there in all its glory. The WSI Equity Ex-Top 100 Long-Short Fund. Yeah, it's a mouthful, no doubt about it. But here's the cool part. Every single word in this name is basically a map telling us what the fund's core strategy is all about. So let's follow that map. And that brings us right to our first stop. We're going to break down the jargon because, honestly, once you understand the name, you understand the entire investment. It's like the instruction manual is hidden right there in plain sight. First up, it's an open-ended fund. What does that mean for you? In one word, flexibility. It just means you can buy in or sell out on any given business day. There's no special window, no lock-in period. You have easy access to your money. Simple as that. All right, now for the next piece of the puzzle. Equity Ex-Top 100. Equity is easy, right? It means the fund invests in stocks. But that little phrase, Ex-Top 100, that's really important. It tells us the fund is specifically looking outside of the 100 biggest, most famous companies on the market for its primary investments. So if it's ignoring the giants, where exactly is it looking? Well, its hunting ground is in what we call mid-cap and small-cap stocks. We're talking about companies that are not household names, at least not yet. This is where fund managers often go to find what they hope are the next big thing. You know, those hidden gems with a lot of room to grow. And that brings us to the real heart of the strategy, maybe the most fascinating part of the name, long-short. This tells us the fund does more than just pick stocks it likes. This describes the very engine of the fund, and it involves making bets both for and against certain companies. So let's pop the hood and see how this engine actually runs. Really getting a handle on this long-short strategy is the key to understanding how this fund tries to make money, whether the market is going up, down, or sideways. Okay, so a long position, that's probably what you think of when you think of investing. You buy a stock, you hold it, and you hope the price goes up. Easy. A short position is the total opposite. It's a bet that a stock's price is going to fall. The fund actually borrows shares, sells them immediately, and then, if the price drops like they predicted, they buy the shares back cheaper, return them to the lender, and pocket the difference. This is the big deal. It's a way to potentially profit even when a particular stock is doing terribly. Now, this chart shows you how that all comes together. As you can see, the huge majority of the fund is in those long positions on mid and small cap stocks. That's the main growth engine. But then you have these other slices that give the manager flexibility, including that all-important piece reserved for the short positions. And this brings us to a really important rule for this fund. The official document is crystal clear on this point. The total exposure to those bets against the market, the unhedged short positions, can't be more than 25% of the fund's assets. That's a critical risk management rule built right into its DNA. So after all that, after all this talk of long and short and complex strategies, what's the goal? Well, the fund document says it right here, plain and simple. It's to generate long-term capital appreciation. All those moving parts are working towards one single, straightforward goal: growing an investor's money over the long haul. Now, of course, any strategy that involves actively betting against companies is going to have some serious risks. So let's take a deep breath and talk about the warning label. What are the dangers involved here? The fund's own documents show this official risk meter. And, well, look at that. It's cranked all the way up to 5 out of 5, which they classify as higher risk. This isn't a suggestion. It's a very direct statement that this is not a low and slow kind of investment. So why is the risk so high? Well, for a few big reasons. First, when you short a stock, your potential loss is theoretically unlimited. Think about it. A stock you buy can only go to zero, but a stock you short can go up forever. The fund also has to use complex things called derivatives to make these short bets. And you're combining all of that with the fact that smaller company stocks are just naturally more volatile. You put all that together, and yeah, you get a high-risk strategy. Okay, so we've covered the strategy, we've covered the risks. Let's get down to brass tacks and talk about the price tag. What does it actually cost to have your money managed this actively? The big number to know is 2.25%. That's the maximum annual fee or total expense ratio that can be charged. Think of it as the yearly cost of running the fund. It covers everything from the manager's research to administrative costs, and it's taken directly out of the fund's returns.
And this little example really shows you the impact of that fee. You can see how the expenses take a bite out of the final returns. It also shows you the difference between a regular plan, which is more expensive because it includes commissions for a distributor, and a cheaper direct plan. And trust me, over many years, that small difference in fees can add up to a whole lot of money.
But hey, there is some good news on the cost front. This fund has 0 entry and exit loads. That means you don't get charged a fee just for putting your money in or taking it out, which is definitely a nice little perk.
All right, we have covered a lot of ground here, from the jargon in the name, to the risks, to the costs. So let's boil it all down. What are the key things you absolutely need to remember from all this?
Here it is in a nutshell. This is a high-risk fund. It's actively managed with that complex long-short strategy. Its focus is on mid and small-cap stocks. The goal is long-term growth, and it offers you daily liquidity because it's open-ended. That's the DNA of this fund, right there. And that really brings us to the final and most important question. Now that you know how it works, what the risks are, and what it's trying to do, the real question is for you. Does a high-risk, highly active strategy like this actually fit with your personal investment philosophy and your tolerance for risk? Answering that question for yourself is the most important takeaway of all. Thanks for tuning in.